Hi, my name's Nick Radge, Head of Trading and Research at the Chartist.
Hello, I'm Tony Featherstone, Consulting Editor of the ASX Investor Update e-newsletter. I'm here with Nick Radge, Head of Research and Trading at the Chartist and author of the new book Unholy Grails, A New Road to Wealth. Nick has been an investor and trader for 26 years and worked in dealing rooms in Sydney, Singapore and London, and he consults to stockbroking, accounting and financial planning firms on money management matters. Now, the purpose of our interview is threefold. First, we'll ask Nick to explain charting and how it works. Then we'll ask Nick to explain the style of charting he uses, which is known as momentum trading. And finally, we'll get Nick's view on the Australian share market. Welcome, Nick.
Thanks,
it's great
Tony.
to see you.
Thank you.
So, Nick, what is charting?
Charting is the study of the market itself rather than the companies that make up the market. So we look at things like price, we look at volume, we look at volatility.
So charting seems pretty popular these days. Why are more people using it?
Yeah, charting has become a lot more popular because it's much more of a timing tool. So fundamentals tell you what to buy and charting tends to tell you when to buy, so you can put them together nicely.
So Nick, to a layperson, charting, to me, it almost seems too good to be true. So I look at a share price, I'm looking for patterns, I'm ignoring all the technical company info and broker reports and media stories and just looking at the chart. Is it really as simple as that, charting?
The view is that charting or the market is fully pricing in the information currently known. Okay, that's the first thing. But the other thing to understand is the charting itself is not making the money. The money is made from the mathematics behind it. But charting gives us a reason to be involved and a reason to extract ourselves from the market. So it's a much more of a comfort tool, if you like. People find comfort with fundamental analysis, and that's one tool. We use technical analysis. It's just another tool.
So to summarise that, I could use fundamental analysis to figure out what to buy and sell, but charting could help me tell when to buy and sell it.
That's correct. So the problem with a lot of value investing, for example, is you have to wait until the value is realised of the company. That may take 6 weeks, it might take 6 months, and in some cases it might take years. Time is money. So by using technical analysis, we can help reduce that time factor and get us involved when the move comes along.
So is charting just for traders or active investors? Could a long-term portfolio investor use charting as well?
Absolutely. You can use any time frame.
Yeah.
So a lot of traders would use daily time frame. Investors can use weekly and monthly time frames. Absolutely.
Now, Nick, some people watching this video will say, charting can't possibly work because the theory says that past share price performance can't predict future performance, so why on earth would you use charting? So why does it work in your opinion?
We're not actually predicting. This is the big misconception. We don't predict. The market is driven by sentiment of the players in the market itself, and human sentiment, fear, greed, ego, everything is always the same. It has been for hundreds of years, and their actions create price patterns, it creates trends, and all we're trying to do is say, right, we have a trend established, chances are it may continue, and we just hop on board.
So really what you're saying is charting a way of getting a snapshot of the market psychology towards a particular
Absolutely.
stock. So it's quantifying how people are thinking about a stock.
Absolutely. Think about, say, when Warren Buffett comes into a stock, he has to come in with a lot of force, a lot of effort, and that will leave some kind of a mark on the market, whether it be in volume or price or whatever it is. And those footprints, if you like, are what we try and look at and find out whether the smart money is coming into the stock, and then we can take advantage of that.
So Nick, most people watching this video will use fundamental analysis in their investment decisions. So they'll look at company information, they might read the annual report, the profit and loss statement, they might read the newsletter from their broker or the media report on the company. Can you combine that style of investing with charting, and what would be the benefit of doing so?
Absolutely. So what you would do is you would hone down a group of stocks based on the fundamentals. So you would find stocks that potentially are trading below their value or have some kind of growth potential in them. And then you would come to the charts and find out the best time to try and buy that. Obviously, when we're investing in the stock market, we can only make money when the share price rises. Okay, we can't make money if the share price goes sideways or down. So you can establish a group of companies that have strong fundamentals, and then you could establish a point at which the share price starts rising that you could buy in, and then you would ride that rise.
Okay, so Nick, you favour a particular style of charting known as momentum trading. How does that work?
Look, I've been doing that for 26, 27 years now. The best analogy I've come up with is like a hitchhiker. So we're sitting here in Sydney today. Let's say we want to catch a ride or hitchhike to Brisbane. The first thing we're going to do is go and stand in the northbound lane of the Pacific Highway. I'm tipping that if a car is going to Brisbane, it's going to be in the northbound lane, not in the southbound lane. So we're standing on the right side of the market to start with. Then what happens, we don't know what car is going to stop to pick us up, like we don't know what stock is actually going to go up at any particular period of time. But we do know if we stand on the side of the road for long enough, a car will stop. And we know if we stand on the side of the market, a share price or a share will go up at some stage. So all we do is jump onto that. Now the next thing to understand is we don't know how far that ride will take us. If we hop onto a ride here, it might take us to Newcastle, it might take us to Coffs Harbour, it might take us all the way to Brisbane. We don't know that when we get on. And same when you get on a share price. We don't actually know how far it's going to go. But we do know if the ride changes or turns, we'll hop off. And that's all we do, and eventually we get to our destination.
It's an interesting analogy, isn't it? Because you're just looking for stock that's going up, you're going for the ride. If it's not the right stock, you get off.
That's exactly right. Simple as that. As simple as that sounds, that's all we're doing.
Yeah, I see lots of investors, particularly during market shocks, they'll ride the stock all the way up and then they'll hold it all the way down and the share price starts to look like a tombstone.
That's right.
And it keeps going down and they're thinking, well, it'll eventually come up. And it doesn't. So it's very important with the timing, isn't it?
Absolutely. And it keeps you out of, it automatically keeps you out of those stocks that eventually may go bankrupt. You know, think of the Babcock and Brown and those kind of stocks that during the GFC went to nothing.
So you'd identify points on the chart where if it breaks that point, you sell. And you cut your losses.
Correct.
And you'd identify points where if it goes above that point, you'd buy.
Absolutely. As simple as that.
Things I struggle a little bit with momentum trading is it seems to be the opposite to me of value investing. So when a stock's going up, you'll see brokers saying, well, it's hit its fair value and it's becoming expensive, time to take profits. And when it's going down, you often see brokers saying that stock's getting cheaper. Yet with momentum trading, you're saying buy it when it's going up and sell it when it's going down. Is there a risk that we could be buying stocks that are getting more and more expensive on the way up and selling stocks that are getting cheaper and cheaper on the way down?
Well, that's a risk, but you have anchored yourself to expensive and cheap. What is expensive and cheap? It's nothing but really an opinion.
Yeah.
And that's what it comes down to. I have no such anchor, if you like. So valuations are a fluid event themselves, just like share prices are. We don't make money from the valuation. We make money from the share price. So that's what we're trading. The share price up, not the valuation. The share price, that's what we're moving.
So could I be one of those investors who confuses price and value and bases their decisions on the chart? So if it goes up, it must be expensive. If it falls, it must be cheap. So it's very important not to mix up that price and value, isn't it?
That's exactly right. It is complete opposites. And that is difficult for some people.
Yeah. So what could go wrong with your theory?
I could be completely wrong. But if I'm wrong and the trend changes, we hop off.
Yeah.
And that's the good thing about it. So during the GFC, for example, because we don't make any predictions, we just get off the ride.
Yeah.
During the GFC, we were fully in cash by June, July 2008.
Right?
And we just sat in cash. We didn't predict the market was going to collapse. Call us lucky, but the trend was definitely down. And we waited, then it turned up and we hopped back on again.
So to use that great old share market saying, with momentum trading, you let your profits run and you cut your losses.
Absolutely.
And you're not trying to predict.
No prediction whatsoever. It's a game of mathematics we play. So let's say, for example, if I make 10 trades, and let's say I only get 5 of those right, people will automatically think, oh, you're not very good at this. But the 5 I get right, if I make 4 times the amount of money than what I lose on the 5 I get wrong, mathematically, I'm well ahead of the game. And I'll take that equation every day of the week.
Nick, you realise there's a multi-billion-dollar industry out there trying to predict the share market and forecast stocks and value them in the future. In your view, is that a bit futile? It
is completely futile. But that's what we're brought up to do. You know, that's just human nature. That's what people want. Yeah. Let's call it ego, whatever you like. You know, I picked this one to go there and I picked that to go there. At the end of the day, nobody knows what's going to happen. Absolutely nobody knows what's going to happen.
So Nick, fantastic. Nick Radge, thanks for your time.
Thanks, Tony.